Precedent Transactions Analysis from the Corporate Valuation and Financial Modeling course by Anish Patel. So when you're looking at valuing a company, there's three primary methods to go about this, especially when you think about it from the investment banking perspective. There's a discounted cash flow analysis, comparable company analysis, and precedent transactions analysis. Today we're going to be walking through the precedent transactions analysis. So when you're conducting a precedent transactions analysis, your first step is to determine the relevant transactions. Second is to determine the multiples to measure. Third is collecting all that data. And fourth is spreading those comps. This is all very similar, and you'll notice that these steps are almost identical to the comparable company analysis because both are essentially the same idea, except for, comparable company analysis looks at companies who are trading publicly currently, comparing your company against the trading multiples of their peers on the market right now, while a transactions analysis looks at where one of your company's peers was sold at, what the value was when it was bought or sold. So when you're determining the relevant transactions, you have to think about it from a qualitative perspective. That means thinking about, are the products similar? Are the suppliers and consumers similar? And, are they geographically on the same lines as the company I'm valuing? And as well as the type of transaction that's happening is very important. Additionally, you want to look at the quantitative values, such as, is the transaction size relatively similar to where my company is going to be? What's the type of performance that this company has had? And, finally, the sources that you would use are merger proxies, equity research, news, and SDC Platinum. And finally, 10Ks. The multiples that you would look at, are the measure of a company's value over the measure of a company's performance. And there's different types of multiples. There's the enterprise value multiples, which take the enterprise value over the company's performance, which is relative to the whole capital structure of the company. So EV to EBITDA is one, EV to EBIT is another, and for example, the third would be EV to sales. And then there's equity value multiples, which look at just the equity portion of the capital structure. So, as the name implies, you'd be looking at price to earnings or price to book. And finally, there's industry-specific multiples. These can be for oil and gas, you look at something like total reserves over annual production. For retail, you might look at sales over total square footage. And finally, for airlines, you might use passenger revenue over available seat miles. The step of collecting the data itself is going to take you to a number of different sources. You can look at company 10Ks and 10Qs, where they discuss the details of various merger activity. You can look at merger proxies. You can look at 8Ks. Spreading the comps itself is very similar to how you would look at it from the perspective of a comparable company analysis. So I'm going to move over to Excel and walk you through a little bit of how that's done. You'll notice that this spreadsheet is very similar to the comparable company analysis that we looked at previously. There are a few different changes, and I'll walk you through exactly why and what kind of significance that these differences have, and as well as how this process works if you didn't get a chance to view the comparable company analysis yet. The first column you'll notice is the announcement date, followed by the acquirer name, the target name, the equity value, which is the net debt, and the enterprise value. So these are all, this is all essentially information for you to identify the transactions itself. These are your peers. So, if I'm looking at target company 1, I want the company I'm trying to value, I would look at transactions where the peer was bought. And so this would be peer 1, peer 2, peer 3, peer 4, and the equity value would be how much money was paid for that actual company. So these are all very relevant in terms of just making sure that the information is there so that whoever is reading the output understands exactly what transaction they're looking at. And these metrics are all based on the target. So the net debt of the target, the enterprise value of the target, of the valuation that it was bought at. Similarly, these metrics are the performance metrics. They too are of the target at the time of the sale. And these are sales, EBITDA, and net income. The different multiples that we can look at are enterprise value to sales, which would be simply taking the enterprise value and divided by sales. You can look at enterprise value to EBITDA, which would be enterprise value over EBITDA. And finally, price to earnings, which is, like I mentioned before, the equity value multiple. You can just take the equity value that it was bought at divided by the net income of the company. Or if you were looking at it from a comparable company analysis, it would be the market value over net income, or the price that the company is trading at over the earnings per share. But here, because we're looking at it from a transaction perspective, you're looking at the equity value, the purchase price, divided by the net income of the company at purchase. To come up with an implied range for your target company that you're trying to value, you'll first start by making it a range for the peer transactions. So this could be anywhere from a minimum, first quartile, median, third quartile to a max. Could just be first quartile to third quartile. It's really highly subjective on how much you want to limit your range. So this is done simply by taking the minimum of all of the EV to sales multiples of your peer transactions, first quartile, the median, third quartile, and the max. Similarly, it's the same for all the other multiples. For your target company, you'll be just taking the performance metrics, which then you would apply to get your implied price range. So I would be looking at a net income for the price to earnings multiple, and for the enterprise value multiples, I would be looking at sales and EBITDA, and then creating my implied price ranges based on that. So using the equity value multiple, you'll notice that my implied price range has been limited to a first quartile to a third quartile, and the way I get that price range is by taking the price to earnings first quartile multiple, which I determined from my peers, from the precedent transactions, multiplying it by the earnings per share of my company, the company that I'm trying to value. Similarly, it's the same thing for the median. You would take the median price to earnings from your precedent transactions and multiply it by your earnings per share to get the price. And this is how you develop the range using the equity value multiples. And you'd go through the same exact process for the enterprise value multiples, except you would be backing out to an equity value prior to getting an implied price. So here, I would first look at the implied enterprise value range. So it's as simple as taking the EV to sales of the first quartile from your precedent transactions, multiplying it by the sales of your target company that you're trying to value, and getting the implied enterprise value at the first quartile. Then for the implied price, the equity price, the share price, you would take that implied enterprise value that you've determined, subtract out the net debt which you've calculated, and divide by the shares outstanding to get that share price that most of you are probably looking for. And it's the same process for the median, the third quartile range, etc. As I mentioned in the comparable company analysis, what you actually show in terms of an output is very different from what the intermediary calculations are. So for the precedent transactions, these three columns would actually not be relevant, as what we're actually looking for is the multiples, and these intermediary calculations would disappear. So we shrink those down, and we can see that it would be something along the lines of the information about the transaction, which would be first, and then followed by the multiples that you're looking at. And this would probably range out a few columns further out here, where you'd be looking at multiple other things as well, such as growth, and other multiples, and you'd probably have a few more transactions as well. So it wouldn't be quite as succinct as it is here. And also, your output would not include, this implied target price or implied price range. These would also be on another sheet or, on another page. But for the point of keeping everything as simple as possible, we've put it all on one page just to get the point across and get the concept across. And you can download this model as well as, read all the steps and work with this model straight on our website, which is valuationuniversity.com. And, now I'll get back to the course and go over the topics a little bit more in depth as well. I just want to note that scrubbing the inputs is one of the most time-consuming steps, as all the metrics need to be apple to apples. And the metrics I'm talking about are numbers like EBITDA and net income, because you'll notice from company to company, they're going to be using different methodologies to come to that final number. One company might be adding something in and another might not be. So to get things to be as perfectly seamless as possible, you have to go through and go and look at the fine print of how these metrics are calculated and back out things that just don't make sense. So just to go over everything we did so far, the Precedent Transactions Analysis, it's 4 steps. You determine the relevant transactions, determine the multiples to measure, and you collect the data. And finally, you spread the comps. And then the implied valuation, as we went over in the Excel spreadsheet, you take the peers, median price to earnings, or first quartile price to earnings, whatever multiple you want to use, times the target's metric. So in this scenario, because we're looking at price to earnings, you would multiply by the target company that you're trying to value's earnings per share, and that gives you an implied share price. So, some of the pitfalls are it's difficult to find true relevant transactions, which makes sense because you're not going to be able to find companies that match all the qualitative and quantitative features that we discussed before on a perfectly apples to apples basis. Market conditions and sentiment. A transaction that's been done 5-10 years ago is going to be done under different conditions. You might be going through a tech bubble and, maybe the companies are all valued at a much different rate than what they're valued at right now. So the conditions and sentiment affect this valuation as well as, the range is highly subjective and should be higher than other valuation methodologies, because when you are looking at, mergers and acquisitions, in any sort of takeover, there's a premium. Any company that's being bought wants to be bought at a premium than what it's trading at. And so whatever valuation you derive from doing your precedent transactions analysis will be higher than what you get from a comparable company analysis and typically from a DCF, except for a DCF can swing both ways because it's also highly subjective. So, that's just to summarize. This is the corporate valuation and financial modeling analysis course. We just went over the precedent transactions analysis. You can watch our other videos on comparable company analysis as well as discounted cash flow analysis. And, remember to visit us at valuationuniversity.com. If you guys have any questions, feel free to just shoot me a message through our contact form, and I'm more than happy to help anyone out with, any questions you have. Thank you.